Welcome. Take a moment to consider a market that feels entirely disconnected from reality. We are in late April 2026, and we are witnessing one of the most intense identity crises in the history of the automotive and technology sectors. Today, we are looking at the massive divide between visionary tech promises and harsh, undeniable financial gravity.
It is a fascinating battleground right now. You have long-term potential colliding head-on with short-term financial realities. The market is essentially asking a profound question. How much are we willing to pay today for a future that might be a decade away?
Exactly. And nowhere is this tension more obvious than with Tesla. If we look closely at the data, the stock is in a highly precarious position. We are seeing a massive $25 billion capital expenditure surge directed at artificial intelligence and robotics. Yet, at the exact same time, the core automotive business is showing undeniable signs of fatigue.
It is the ultimate venture capital pivot. Tesla is essentially asking investors to treat it like a startup all over again. They are pouring money into full self-driving, the Optimus robot, and Robo-taxis. But here is the fundamental problem. The market is being asked to swallow a 314 times price-to-earnings ratio for a company that just posted negative 2.93% revenue growth. The math simply does not work in the short term.
A 314 PE ratio is traditionally reserved for a hyper-growth company that is doubling its earnings year over year. It is not meant for a company where net income has plummeted by nearly 47%. It feels as though the market is pricing in a decade of flawless execution today, ignoring the immediate deterioration.
That is the perfect way to frame it. It is the gap between the current EV winter and the promised autonomous summer. Tesla's return on assets is sitting at a dangerously low 2.7%. That tells us the massive capital tied up in their gigafactories is just not generating efficient returns right now. Price cuts are no longer stimulating enough volume to offset the margin compression, leaving net margins hovering around 3.96%.
There is a certain irony here, though. Despite the shrinking margins and the demand problem, the Q1 2026 earnings did show a surprise profit beat of 41 cents versus the expected 35 cents. And their balance sheet remains pristine, with a debt-to-equity ratio of just 0.11.
That is the silver lining. They have roughly $14.7 billion in operating cash flow, which means they actually have the war chest to fund this AI gamble without risking insolvency. The energy storage division is also growing rapidly. But in a high interest rate environment, the broader market is prioritizing immediate cash flow over speculative 5-year bets. Institutional money is shifting from Elon will figure it out to show us the money.
Let us shift our focus to the technical landscape because the charts are telling a very specific story. The stock is currently trapped in a downward channel, exhibiting what analysts call a coiling pattern. It is essentially stuck in no man's land.
Right, it is hugging its volume-weighted average price, creating a temporary equilibrium between buyers and sellers. But do not let that quiet period fool you. The average true range is nearly $15. That means the stock can swing 4% in either direction in a single day without actually changing the overall trend. For swing traders, entering right now is essentially a coin flip.
The moving averages paint a rather bleak picture as well. The stock is pinned below both the 50-day moving average of $387 and the 200-day moving average of $400. In technical terms, those are heavy ceilings.
Exactly. Until the stock can reclaim that $400 level on high volume, any rally is likely just a dead cat bounce. Long-term institutional smart money is either exiting or staying on the sidelines. The path of least resistance is down, and if the immediate support at $369 fails, there is a vacuum down to the $350 psychological floor. or even the 52-week low near $260.
It is a profound shift in market psychology. We are seeing physical manufacturing take a backseat to algorithmic futures. But this brings us to a starkly contrasting situation. While one company is chasing a $10 trillion robotics market, Stellantis is taking a completely different approach to the current economic environment.
Stellantis is a classic value play wrapped in a thick cloud of legal and operational uncertainty. Their CEO is aggressively trying to trim the fat with a four-core strategy, prioritizing their most profitable brands: Jeep, Ram, Peugeot, and Fiat. They are even exploring selling or sharing European plants with Chinese rivals to lower fixed costs.
It is a highly pragmatic, defensive maneuver. They are trying to protect their dividend and buyback capacity, but the market seems entirely fixated on the negative catalysts.
And for good reason. There are multiple law firms, like Robbins LLP, actively soliciting investors for a class action lawsuit regarding disclosures made between February 2025 and February 2026. That creates a massive headline risk that keeps institutional buyers away. Combine that legal overhang with high North American dealer inventory and declining sales in Canada, and you have a recipe for severe earnings anxiety.
Which makes their upcoming Q1 earnings release on April 30th a definitive make-or-break moment. If they can show margin stabilization despite the drop in sales volume, we might see a relief rally. But until then, it is a high-risk waiting game.
Precisely. Stellantis is fundamentally cheap, but the combination of a class action lawsuit and a high-stakes earnings report makes it a no-fly zone for the immediate future. The restructuring is the right long-term move, but the short-term volatility is going to be intense.
As we wrap up our analysis today on the U.S. Stock Picker podcast channel, we need to synthesize all of this complex data into actionable insights. We have explored the philosophical divide between AI dreams and automotive realities. But now, let us deliver the definitive strategic breakdown for our listeners.
Let us go through the exact blueprint. First, looking at new sentiment analysis. The sentiment for Tesla is cautious to negative, as retail fatigue sets in and institutions demand proof of ROI on their massive AI spending. For Stellantis, sentiment is heavily weighed down by class action solicitations and earnings fears.
Moving to fundamental and strategy analysis.
Fundamentally, Tesla's extreme 3-14 PE ratio is entirely disconnected from its negative revenue growth, making it a strong sell based on valuation. Their strategy is a high-conviction pivot to AI. Stellantis, on the other hand, has strong fundamentals through its four-core optimization strategy, but is rated a hold due to near-term operational headwinds.
And what about swing trade analysis?
For Tesla, it is a wait-and-see environment due to the coiling pattern and high daily volatility. You have two scenarios: a bullish breakout requiring a daily close above $387, or a bearish breakdown if it closes below $369. Do not front-run these moves.
Which leads us to the buy and sell by recommendation of when to start investing.
For Tesla, the recommendation is a strong sell. Do not catch the falling knife. You should only start investing or initiate a new long position when there is clear confirmation that the trend is reversed, specifically waiting for a weekly close above the 200-day moving average. For Stellantis, prospective buyers must wait until after the April 30th earnings call provides clarity on inventory and margins.
Let us be specific about what price point to start investing at.
For Tesla, a high probability entry only exists if the stock reclaims the $400 level, or if it drops into the deep value zone between $310 and $320.
And crucially, when to leave the market.
You leave the market when the technical floor gives way or when the fundamental narrative breaks. If you are holding Tesla, you need to protect your capital against a fundamental re-rating.
Finally, what price point to leave the market at to mitigate risk?
For current Tesla shareholders, Consider trimming your positions on any relief rallies toward the $385 to $390 range. If you are swing trading, use a strict stop loss order at $369, which is the 20-day moving average. If that support fails, the downside risk accelerates quickly.
A brilliant and sobering breakdown. The line between visionary investment and valuation trap has never been thinner. Thank you for joining us today on the U.S. Stock Picker podcast channel. We will continue to monitor these critical levels.
The information provided here and on this channel is for general informational and for education purposes only. It does not constitute investment advice, financial advice, trading advice, or any other sort of advice. We make no recommendations regarding investment decisions based on this information. You are solely responsible for your investments. Please conduct your own research and consult qualified financial advisors before any investing. SEO video title, TSLA, Crash or Surge, Technology Stock Predictions and Growth Stock Picks. Stock Trade Podcast, Upside Potential Stocks and Pop Stocks.